Good afternoon, everybody. Today is Friday, April 5th, 2013. I'm Andrew Packer, editor at Newsmax, welcoming you to our monthly financial brain trust call. I'd like to welcome our Alliance subscribers to the live call. If you would like to ask a question for our special guest or any of our brain trust members today, you can hit *3 to be connected to a call screener. Also this month, we do have a poll for the first time. Today's poll question is, how much of your total net worth is in U.S. dollar-based investments and assets? If you have between 0 and 25% of your wealth in dollar-based assets, you can just press 1 to vote for that. If you have between 26% and 50%, you can press 2 for that. If you have between 51% and 75% of your money in U.S. dollar-based assets, you can press 3 for that. And finally, if you have between 76 and 100% of your net worth in dollar-based assets, you can press 4 for that. For our Brain Trust members, please remember that these calls are being recorded. If you are not speaking, please put your phone on mute to minimize background noise. As always, please speak clearly and say your name when you first start speaking. That said, this month it's my pleasure to introduce our special guest, Axel Merk. Axel is the President and Chief Investment Officer of Merk Investments. He's an authority on currencies and a pioneer in the use of strategic currency investing to seek diversification. He's a well-sought-after speaker and author, as well as a regular contributor to the Wall Street Journal, the Financial Times, CNBC, Bloomberg, and his articles appear on Money News and in the Financial Intelligence Report. Mr. Merk, together with his portfolio team, manages a variety of currency funds. He holds a BA in economics and a master's in computer science from Brown University. So at this time, I'll turn things over to Axel to talk more about the current state of the economy with a specific focus on the currency markets and how that may affect things going forward. Axel?
Yes, thank you. And this is Axel. Thanks for a kind introduction. I'll talk for 10 to 15 minutes, and then I'll pass it back for hopefully a long and interesting Q&A. And first thing, I'm not going to tell you about technical currency strategies. What we are known for is our macro views on the world of currencies, and indeed on how to project our macro views onto the currency space. And let me give you first a little bit of background as to why this is relevant. I'm sure that all of you have heard about the quote-unquote raging currency wars. Well, what better place is there to either defend yourself against currency wars or potentially profit from currency wars than in the currency space itself? And I'm not encouraging everybody here to become a currency trader, but we consider ourselves currency investors more. Think about it from a different perspective maybe. We saw the Bank of Japan. I'll talk about Japan here in more detail in a few moments. But when they print a great deal of money, well, lots of things happen in the world. There are ripple effects to the bond markets, to the equity markets, and so forth. But if, for example, the only reason why you're buying U.S. equities is because you think quantitative easing is going to propel equity prices higher, you're taking on a great deal of noise because equities are inherently volatile. Not only are they volatile, but the volatility in the equity space is all over the place. In 2008, it was through the roof. In other times, it's reasonably calm. What's nice about the currency space is that the volatility is much more range-bound. In recent days, we've had some dramatic moves in the currency space, but even when the euro goes up a cent, that makes the headlines, but on a percentage basis, it's much less. So if you don't use leverage, the currency space actually is far less volatile than many people think. And so what we think is that if you have a view of what the mania of policymakers is, well, go to the currency space to express those views. You may not like what Obama, Bernanke, Merkel, Draghi, or the head of the Bank of Japan or somebody else may be up to, but I think most of us would agree that they're reasonably predictable. And so it's in that context that I'm going to tell you here about our views of what's happening in the world, because I think that the currency space is a wonderful place to add value with active management in particular. And so with that, maybe let me start in what's been happening this week, because we've had three rather substantial items happening this week. The Bank of Japan meeting, the European Central Bank meeting, and then obviously the unemployment report today. And while obviously we're coming from a U.S. perspective, what's happening in the rest of the world has a major and significant impact in the U.S. And let me start with Japan maybe. And the reason I want to start with Japan is because I want to give you a little bit of taste how we think about currencies. In Japan, historically, everything appeared to be backwards. Many people have said that the yen is doomed for many years, if not decades. How can you carry a massive debt to GDP ratio now exceeding 200% of GDP? Well, the answer in the past had been, and I'm talking about the past, is because they did not need foreigners to finance their deficit. They had a current account surplus, which means that the debt deficit was financed domestically. What that means basically is that if you have a shock to your economy, like the earthquake that hit a little over 2 years ago, well, that means there's increased consumer savings, there's less spending. That means the currency actually went up when the earthquake hit. In many ways, the more dysfunctional the Japanese economy has been, the stronger the yen has been. When you have 7 prime ministers in 7 years, or stop counting because there's so many, that means you have a government that's not effective. An ineffective government is one that cannot spend money. An ineffective government that cannot exert pressure on the Bank of Japan. Contrast that, for example, with New Zealand, where there also was an earthquake about 2 years ago. In New Zealand, you have a current account deficit, while the earthquake hit and the New Zealand dollar went down. Now, the rebuilding effort is underway, and as you have the rebuilding effort, well, the central bank might need to be tighter than otherwise, and that might be a positive force for the New Zealand dollar. So we're not suggesting here that the current account balance is going to be a perfect predictor of exchange rates, but it does give an indication as to dynamics. Just as different stocks behave according to different sort of dynamics, different currencies behave to different sort of dynamics. It's not just the dollar versus everything else. There are moves within those currencies. And to also put that in different perspective, last year, for example, when we had this major crisis in the Eurozone, well, most of you may not be aware, but the dollar was actually down versus all major currencies except for the yen. The dollar was down about 2% versus the euro last year. Most people are not aware of that. This year, the dollar is up still a tad versus the euro, but not much. It appears to be losing some of that. But back to Japan. What has changed in Japan as of last year, late last year, that indeed there is a strong government. Abe's government has a 2/3 majority, and so now they're actually getting things done. The finance minister has made it clear he wants to pursue Depression-era policies, so they're going to be spending money. And on the monetary side, and that's the news this week, they want to be more aggressive. Well, what happened the last couple of weeks is that the top 3 people at the Bank of Japan were replaced, a new governor, 2 new deputies. Last year, 2 dovish people were put in place there. And so you have a complete revamp of the Bank of Japan. And many people, including us, were expecting that they're going to do something. They're going to take out a big bazooka. The only problem was, of course, expectations were so high so that there was a risk that no matter how big they would come, a surprise they would come out with, that the market might be quote-unquote disappointed and the market might rally. Well, fear not, they know how to play the communications game, and early this week they lowered expectations. And as they came in now with their announcement to print, if you compare it to the level of GDP, about 2 to 3 times as much as the Fed does a month, they did indeed surprise the market. Now, as I indicated, we rarely talk about short-term trading opportunities, but more about major themes and bigger opportunities, and that's what we do in our mutual funds also more specifically. But the reason why we are very negative on the yen, and this isn't just a trade. We published a paper an analysis last November with asking, is the yen doomed, ? And have since removed the question mark. The reason is that the dynamics have changed for the yen. I was referring to the current account balance before. Well, the current account balance has slipped into deficit, which means that the major deficit that Japan has is going to matter going forward. And in our view, policymakers do not appreciate that. They think they can regulate how far this will go. And I think they don't know what they're up to. And we have some proof of that. In the past, the yen has been a quote-unquote safe haven. In 2008, the yen was the best performing currency, even doing better than the US dollar. Well, if you look at the correlation between the yen and the VIX index, the S&P Volatility Index, for example, that correlation has been deteriorating. And it's been deteriorating just about in tandem with the deterioration of the current account balance, which means that as future crises will happen, the yen is not going to be the place anymore where people flee to. Up to some degree, maybe for a while, but not in the medium to long term. And that's why we are very negative on the yen. Our price target for the yen is worthless as an infinity. And I just had a email correspondence with a Financial Times reporter yesterday, and it's not the first time that they ask me, oh, what's this and this, what's the target? And I casually mention worthless, and then they come back with, what's your price target? And I respond, well, I thought I was pretty clear on that, worthless, and I mean it. We put our money where our mouth is, and we don't see how this can end well for the yen. That doesn't mean there can't be violent rallies. Now, let's move on to the euro here. Euro, very controversial topic. And this week, there was the first opportunity for European Central Bank President Draghi to comment on what was happening in Cyprus and provide a path forward. Let me give you a little bit of background. In 2010, we put our neck out. We were, I think, the only ones in the U.S. positive on the euro, and that was when the euro was diving down towards 118 versus the dollar. And we said the issues in the eurozone are very serious, very real, but they ought to be expressed in the spreads in the bond market, that the euro is mostly sold for liquidity. And then we were positive. The euro indeed went up to the high 140s. And then in the fall of 2011, we turned increasingly cautious, then outright negative on the euro. The spring of 2012, a year ago, we were very, very bearish on the euro. The reason, though, was that there was no process in the eurozone. Everybody was running around like headless chicken. You cannot price an asset if you don't know where people are heading towards. And then what happened in July, Draghi, the head of the ECB, gave his talk that he'll do whatever it takes. I don't think that was all that relevant. What was much more relevant is in August he announced what he would do. And it's this OMT program, as it is referred to, outright monetary transaction program. And basically what he did is he imposed a process. He told the weak countries, if you guys need help, you give up sovereign control over your budgeting. The stronger countries will agree to the help, then, and which means you're moving towards political integration, then I will act more like a Federal Reserve. That took away some tail risks, but importantly, it provided a path. And that is why this fragmentation in the Eurozone kicked into the reversal. We published an analysis, Draghi's Genius is the title of that, last August, where we suggested that this would be the low for the euro. Everybody laughed at us. We got some hate mail and all kinds of interesting messages on that. But it turns out that was the right call. What Draghi underestimated, and we to extent as well, is that what we saw in Cyprus, that policymakers in Europe are more willing to tax widows and widowers than give up control over their budgeting. They're so proud that they have the control over the budget process, and which they ultimately lose anyway, that they are not willing to go along with the help from the Eurozone unless they're absolutely forced to. And that brings me to another point about Europe. And then I go then bridge over to the US. In Europe, we have seen that the only language policymakers listen to is that of the bond market. Whenever the bond market pressures politicians, they move forward. And by the way, that is a process as well. It's just a very ugly process. And what we've seen now is that we're moving on, and when the pressure abates because of central bank action or otherwise, obviously many of these promises are watered down. And I'm not suggesting the process is great, but we don't have good processes in other countries, say the US, the UK, or Japan either. And what's happening now after Cyprus is that we see the same thing happening in the banking system. It's the depositors voting with their feet that encourage, I use that in quotes, encourage bank reform. What we have in Europe is that we have these national regulators protect the domestic banking systems when it's pretty clear that these peripheral countries have banking systems that are oversized. Well, they're moving way too slowly on centralizing the bank regulation, and in the process you keep these bloated banks there. Now we see an acceleration of the reform, which in many ways is a good process, with depositors voting with their feet. And by the way, in the US it's absolutely clear that if you have more than the FDIC insured amount, you're going to lose money if your bank is insolvent. The problem in Europe is that there's no streamlined process. There is no centralized FDIC. Germany, rightfully so, doesn't want to give a blanket guarantee to all the deposits in the Eurozone. And so they're moving in this piecemeal approach to a central regulator. But aside from the guarantee, what's missing in Europe is the strong resolution authority that is key to having a successful unwinding of these banks. Now, and by the way, the euro, yesterday we had this ECB meeting, first dipped down and then has been, it was down as weak as 124.70 about, and it's currently at 130.28. That's an amazing move within 2 days. Rarely did these moves happen. Going into this meeting, we were very negative on the yen and quite positive on the euro. And the reason was that in the eurozone, despite what people hear, they're actually printing much less money than in the rest of the world. We're printing money at the Fed, the Bank of England, the Bank of Japan, and talk about England maybe during the Q&A a little bit here. But in the Eurozone, the central bank is much less in control of its balance sheet. They are more demand-driven. People were giving, when banks need loans, they go to the central bank and get cheap money. And in return, now what's happening is the banks are starting to repay these loans. So the European Central Bank balance sheet has been shrinking. They're mopping up liquidity. The key reason why you have these issues in the Eurozone is because they didn't print all this much money. And so they actually have to take care of the issues. It's very painful. There are a lot of risks to political stability and so forth that come with that. But if you just look at the currency can be much stronger in that sort of environment. I'm not suggesting anybody to open up a bank account in Cyprus, but if you hold German T-bills, for example, or Northern European Treasury securities, well, those will be around. Maybe they might not be called euros in 20 years from now, but those sort of securities will be around. And the fact that they're printing less money should do quite okay. Now, let me move to the U.S. and then make one general comment before we go to the Q&A. In the U.S., we have an unsustainable budget. I think in this audience, many are aware of that. I do believe we will come to a solution on many of the entitlement reforms, which may sound very positive, but I think that what it takes is a bond market that forces policymakers to do so. The path of least resistance is inflation, and we have a political gridlock, so it's only when policymakers are forced to that they will act. Now, the difference between Europe and the U.S. is, in the U.S. we have a current account deficit. So if and when the bond market tells policymakers to get their act together, it will have, in our view, a far more severe impact on the dollar than it ever had on the euro. And so to kind of sum that up before we go to the Q&A, I sometimes cynically say I don't think we ever had a Eurozone crisis. That's the good news. The bad news is we have a global crisis. It's just morphing to different states. And again, to kind of sum this up, the currency market provides a wonderful opportunity to take advantage of these issues. Ultimately, the simplest way to think about it is there is no safe asset anymore. There is no place to hide. You have to take a diversified approach to something as mundane as cash. The Chinese are diversifying to basket of currencies. And if you pay attention, you can try to retain keep the purchasing power of your savings. But if you're just a plain saver in US dollar, don't think that the purchasing power of the dollar will be preserved. So I'm exceeding here a little bit on my 10-15 minutes. That's why I'm pausing here and give it back to you for some questions. Go ahead.
All right. Thanks, Axel. Appreciate those comments. Just kind of wanted to review sort of the poll so far that I asked at the beginning of this call. Looks like we've got about 54% of our callers today who voted that they've got about 76 to 100% of their net worth in U.S. dollars, and another 21% with 51% to 75% of their net wealth in U.S. dollars. What would be the best way for those folks who are very dollar heavy to start diversifying and start getting into non-dollar based investments and assets?
Well, sure. Keep in mind that, and obviously many people answer these questions with a slightly different way of interpreting them, but many people think, for example, that when they buy the S&P 500, that they are diversified because they are buying companies that are active internationally. Well, it turns out that 90% of the earnings of the S&P 500 is hedged back into the US dollar. So you're getting far less international diversification. The other thing that we have seen is that correlation across asset classes has been very high in recent years, And a lot of that is due to this very heavy engagement of policymakers. We've seen some improvement in that of late, but it's still very, very heavy. And one result of that is that also even international equities are rather highly correlated with the U.S. equities. And the only thing you're pretty much getting with investing in international equities is higher beta. You're getting more volatility. And of course, the challenge is always how do you add something to your diverse portfolio so that you're diversified. And diversified actually means that something could go down when everything else goes up. It feels great when asset prices are floating higher, but where do you hide on the way down? Now, historically, the alternative is, of course, the bond market. Well, in the bond market, you're taking on a lot of interest risk. You're going out the yield curve. And we believe that there is a bond bubble out there. And the best bubble indicator that we have is a very simple one. Look at the volatility of any one asset or asset class compared to its historic average. And what I mean with that is that in the 90s, tech stocks didn't appear all that volatile. Housing market appeared to go only up. When something only goes up, when the volatility goes to below its historic norm, you might have a problem. While if you look at the bond market, the long end of the yield curve is a violent place. In recent years, that volatility has been below its historic average. You don't need the Chinese to dump their bond holdings for there to be a crisis in the bond market. You just need to have normal times return, and a lot of people will have a very rude awakening. So the same thing, not exactly the same thing, but related items apply in international fixed income. And so obviously I'm kind of crossing off all these choices that one might want to invest in. What many have done, if they don't want to move from fixed income to equities, is, well, going to take on more credit risk, meaning buying riskier securities. That's, of course, something one can do. Bernanke and his colleagues around the world are trying their best to foster that. We are rather concerned that if we do hit another crisis, and we have plenty of candidates, that may also not be the best place. And so what we do is, well, we say a special case of international fixed income investing is currency investing. You reduce the interest and credit risk and focus on the currency risk. Now, if you do that, you may want to do active management, because if you just hold your favorite Australian bond, well, or treasury bill even, you're overexposed to just one market. People think everything is great in Australia and Norway. Well, guess what? That might be priced in the market. I gave you a brief good case for the euro, very controversial, but when there's blood on the street, maybe something is also cheaper. If you look around the world, you've got to look at value as well. And so, but the short answer here is that the reason why we've been focusing on currencies is because that provides an opportunity to potentially add diversification. Now, obviously, the other thing I should mention as well is precious metals and the like. They certainly can be also a part to diversify. Keep in mind that the volatility in precious metals is higher than that in currencies. But on the flip side, of course, there's some other attractive attributes on precious metals as well.
All right, thanks, Axel. And as long as you've mentioned precious metals, one of our Alliance subscribers, Meldrum, has asked, what's going on with the silver market currently and the gold market?
Sure. As most of you are aware, the silver market is more volatile than the gold market, historically speaking. Part of that is, and gold, as volatile as gold can be, it's the least volatile of the commodities. We like to focus on gold because we like to keep it simple. People think always currencies are so complicated. We think 10 major currencies are actually much easier to follow than thousands of stocks. And so similarly, gold is kind of the simplest commodity. It's the purest indicator of the monetary madness that's out there. What we have in gold and precious metals in general is we have a transition happening. A lot of folks had bought precious metals because they were predicting the end of the world in the Eurozone. We never bought gold because of the issues in the Eurozone. The reason why we buy gold is because there's simply too much debt in the world. And there is, in our view, no way that we can get through this without either restructurings or inflation, so defaults or inflation. The Eurozone happens to prefer austerity and defaults, but the rest of the world, I'm talking about the Bank of Japan, the Bank of England, and the Federal Reserve, culturally, in our view, appear to favor the inflationary route. And so That's why we're in this transition period where I think we have a lot of consolidation, where we have some holders of gold exiting, and we are rebuilding a base here for these newcomers to come in that only now appear to be aware of some of the unsustainability of our U.S. debt. If you look at the 10-year forecast of U.S. debt, while it doesn't look good, it's not a Armageddon scenario. That Armageddon scenario comes only after that 10-year period, and so some people think we still have enough time. What people don't realize is that if indeed we had inflation pop up in some indicators that the market is going to get concerned about, and I'm talking about the market because myself and I'm sure some of the audience are already concerned about inflation, but the market as a whole, our U.S. debt is not sustainable at 4%. Now, the average cost of financing U.S. debt is currently around 2%, down from about 6% in 2001. It continues to slide downward as higher coupon debt is maturing, going to be refinanced at lower rates, which means we're not going to have an issue here tomorrow, but at least mathematically speaking. But what can come down from 6 to 2% can go back up. And as we saw in Spain, that was very prudent in its debt management, had an average maturity of its government debt of about 7 years. You don't need to have a mathematical problem of financing yourself. You need to have a market perception that you have difficulty financing yourself. And so we think that we haven't seen anything yet in the precious metals market, that gold will be a great beneficiary as becomes a more mainstream view, that indeed we are not coming to a resolution on entitlements, and that in itself, of course, might create the pressures to come to a resolution, but not before we're going to have a major fallout in some of these markets. And so in the meantime, we saw what's happening in Japan. The yen weakened significantly, but gold didn't really react on the news on Bank of Japan, which means the market still believes that this is an isolated Japanese problem. I don't think that's a Japanese problem. If the Japanese have a major problem, the rest of the world has a problem. The Japanese economy is about a third of the size of the U.S. economy. It is very significant and will have implications. At this stage, the rest of the market doesn't agree with my view, but at the same time, I rather be patient and prepared. And conversely, another way to think about it is, I don't know whether any of what I say is correct, but I do know that there's a risk that I'm right with some of my views. And if anybody agrees that there's a risk that I'm right, well, how do you take those scenarios into account, even if we're lucky and some of those scenarios don't pan out?
All right. Thanks for your answer on that, Axel. At this time, I just want to remind our subscribers that if you have any questions for our guest today, you can hit *3 on your phone to call a call screener and get that question out. At this time, I'd like to open things up for some of our Brain Trust members, and I would like to start with Barry Elias. Barry, are you with us?
Hi, Andrew. Can you hear me now?
Yeah.
Okay, great. Thanks, Axel. This is Barry Elias speaking. So now we're talking about real intervention with policy and possible currency manipulation by sovereign entities. Would you subscribe to a currency that's a global reserve currency that's backed by real assets that represent productive use of resource allocation like labor, capital, and raw materials such as gold, silver, or even the new item Bitcoin?
Well, the Bitcoin is not really backed by real assets, but let me address that maybe broadly. Occasionally the talk comes up. Well, you say, would I back a global currency? And in some ways what that suggests is, are we going to have SDRs, for example, the special drawing rights, become a global currency? Are we going to create some other global currency? What we see happening is that all the governments do what they perceive to be in their self-interest. And I say perceived because sometimes they don't know what's really in their own, what should be in their interest. And the Chinese are managing their basket of reserves in what they deem to be most appropriate. A lot of U.S. exposure, trying to diversify, but liquidity dictates that the U.S. is a very big component in that. And so when you have all the stakeholders at the table, everybody wants something else. Somebody wants more liquidity, somebody wants more stability. So I don't think there's going to be a global agreement, so to speak, of a currency, be that one backed by metals or whatever it may be. And instead, what I do see is that in the last 100 years, we've been moving further and further away from the gold standard. And I see that trend continuing, if not accelerating, which means currency is at risk of losing its function as a store of value, and that everybody's on their own. And what I kind of have to say to that is that, well, we should not rely on our governments to come up with these ideas themselves, and so instead we should do something ourselves, which means we can manage our reserves according to our own views. Now, clearly, Bitcoin, for example, is an attempt to do just that. I personally would prefer a currency backed by gold. And what I love about Bitcoin is that it sets up an infrastructure technology to provide an alternative currency. My personal favorite wouldn't be Bitcoin, but I wouldn't mind creating my own currency that is backed by gold. And so that's a project that I might look into. And so it's those sort of initiatives, I think, for that might allow investors to diversify their own reserves. But I don't think that we can count on our governments to come up with something that's ultimately going to serve us, because the interests of governments and of individuals are not aligned. Governments have too much debt. We as individuals have savings. And so we have diametrically opposed goals on how to pursue this. Governments want to inflate the debt away, and we want to increase the purchasing power of our savings. And those two don't jive. And so we cannot rely on our governments to take care of us for us. We have to have our own initiatives on how we manage our savings and our reserves.
Thanks a lot. I agree completely with virtually everything you just said. Thanks a lot, Axel.
All right, thanks, Barry. Next among our Brain Trust members, I'd like to go to Ashish Advani. Ashish?
Hi, Axel. This is Ashish Advani. I just had a follow-up question for you regarding your comments on gold and silver. Historically, when we've seen, the U.S. stock markets go up, we've also seen gold and silver prices correlated, whether right or wrong, move up. We haven't seen a commodity swing up since the stock market, I would say, in the last 3 or 4 months. And also, you talk about North Korean rhetoric, as it may be, about war. You talk about, the crisis around the globe, and yet gold seems to be on a downward trajectory. Do you believe there is strong manipulation either by the Federal Reserve or a consortium of central banks to try and hold gold and silver prices down just to continue to bolster the U.S. dollar?
Many topics you mentioned. Let me dive into different ones here. A couple of ones. First, on the correlation of metals and the stock market. We monitor these correlations very closely. They are phasing in and out, and so they're not always correlated. And indeed, often they signal some major shifts around the world. Let me just point one major shift out here. Last August, when risk was on again, the money did not flow into the commodity currencies that tend to be also correlated to precious metals. It went into the euro. And so we've moved on in some ways from this risk-on, risk-off pendulum that was where you kind of blindly were able to invest in whatever that reflected either risk-on, risk-off. The good news is that we have to start thinking again and have to be a tad more differentiated. And whenever then policymakers act more aggressively, for example, when the G7 came out with a statement ahead of a G20 meeting a few weeks ago, correlation and back up zoomed right into be highly correlated again. And so I think it's a bit too simplistic to just think that gold should be correlated with these other asset classes. I think there are longer-term drivers that drive metals. There are also obviously other factors except for the monetary ones. There's a slowdown in some mining activity. There have been some overinvestments, and so there are lots of cross currents there. Ultimately, of course, the market is there to frustrate as many participants as possible to shake off those weak hands. We like volatility in gold because it kicks out the momentum players. With regard to crises, I'm not overly concerned about these short-term crises such as North Korea and the like. I'm more concerned about longer-term crises. I believe that monetary policy, for example, has a greater impact on the social fabric, on the wealth distribution than fiscal policy has. Aggressive monetary policy helps those who know and understand credit. Inflation benefits the wealthy more or hurts them less than the poor. It increases the wealth gap, which means you have more social disintegration. More populist folks come to power when you have aggressive monetary policy. That's why we have the rise of the Tea Party and Occupy Wall Street in the U.S. That's why we have revolutions in the Middle East. That's why you have a populist leader in Japan. Those sort of things can lead to much bigger wars than what we see on the Korean Peninsula. It's those longer-term trends that I'm concerned about. Now, the third issue that you raise about manipulation. I'm not in the manipulation camp. What I am in the camp of is that most policymakers try to do the right thing, except that the political dynamics and the roles of their jobs that drive them in certain ways. And in some ways, that's a far more pessimistic view, because it kind of suggests that it's pretty hopeless and this is just what they're doomed to do. There is a lot of misinformation out there about what some of the major banks are up to. There's some very valid hedging activity out there. Some of these markets are too big to be manipulated. What I think is a very positive trend is that the money has been flowing from public hands to private hands. As more private individuals own precious metals, there is less of an opportunity there for some of these conspiracy theories, with central banks having sold some of their gold holdings in the past. Now, obviously, we see, especially in Asia, central banks increasing their holdings again. Some of these conspiracy theory have less weight. Now, I'm not ruling out that there might be some, but generally speaking, when I do my investments, I don't think that in the long term any such intervention will drive market prices. It is the market forces. Even central banks are just zipping with a straw in the ocean. If and when the trust in the Federal Reserve deteriorates, there is very little the Federal Reserve can do to stop a run on treasuries. The market is just too big. There are many substitute investments that are highly correlated, and so central banks will be completely overwhelmed. They can try it, but the results will be rather dire. And so the conspiracy theories, I watch them. I don't make my investment decisions based on them, because I do think that there are other drivers there that are the primary influence of the prices of most assets, including commodities and precious metals.
Thank you. Thank you for your thoughts.
All right. Thanks, Ashish. I want to turn back to one of our subscriber questions now. CC asks which currencies you would recommend for the middle term to the long term, and also what views you have on the renminbi and the Swiss franc.
Thank you. The challenge with giving specific currency forecasts is that our views are subject to change. They can change in 5 minutes. We try to have strategic long-term views, and the biggest challenge is just as in the equity markets. Any one stock is more volatile than a basket of stocks. Any one currency is more volatile than a basket of currencies. I try to be provocative in some of my comments to get people thinking. So I did mention earlier Australia and Norway, two places that many people think that are where things are quote unquote right or well. But every one of the commodity currencies, and those two are part of that, have their own Achilles heel. If you buy Australia, you're betting on China. If you buy Norway, you're betting on Europe. If you buy Canada, you're betting on the U.S. And so even if things go well there are many risks associated with that. And the Australian dollar, I think, is a perfect example where things can get expensive when everybody else likes it as well. And the challenge is that the individual, when buying such a currency, they tend to buy a bond, Australian government bond, and guess what? There will be a period when the Australian dollar doesn't do well, and then many investors get cold feet and never look at currencies again. And so that's why we're really encouraging investors to consider baskets of currencies, actively managed baskets of currencies, to mitigate the risk of any one currency. But if I put a gun to my head, there are some places that we like better than others. And right now, we do think that the kind of on the short side, the yen is our clearest view. That you want to be short the yen. As I indicated, our price target is infinity for that. And so you've got to have a good stomach, though, because the volatility will be significant over time. And then for now, we're positive on the euro. Nowadays, I don't get tomatoes thrown at me anymore when I say that the euro might actually be doing okay, because people have realized that there might be an opportunity in areas where there are crises. But I do think that if things normalize in Europe, you can have a euro that's over 140, And with normalization, I don't suggest that they're going to have a central government anytime soon that works. But what I'm suggesting is that people are ever more getting used to the evolution of the crisis over there. The market has become more differentiated. When there's a separate crisis, well, it played out in Cyprus, a little bit in Italian debt. But Spanish debt continued to improve. And so the market has learned how to differentiate. Ultimately, central banks can buy time. By buying time, it means that banks can be strong enough to stomach sovereign defaults. In 2010, people said it's the end of the world if Greece were to default. But guess what? Greece has defaulted and life has continued. And so similarly, we think there will be more restructurings in Europe, but that doesn't mean that the euro is going to be worthless or that the euro is going to be a parity. And so if they get their act together, the euro can be dramatically stronger versus the dollar. And if I look just at a value proposition, the euro offers a lot more value. Now, with regard to renminbi and Swiss franc, maybe let's stay close to the euro, going to the Swiss franc. Think of the Swiss as living in a bad neighborhood and being the only beautiful house in that neighborhood, having a beautiful front lawn. And what the Swiss decide to do is, well, they'll dump their garbage in the front lawn so that they can blend in a little bit more. The Swiss are living off their reputation, and it's going to come back to haunt them. When you're a small country like Switzerland, you can peg your currency to the euro or have your one-sided peg as they want to, but they have significant side effects, like a real estate bubble that they're building up in Switzerland. And so it's a very precarious situation that they're in. And the Swiss are also making a major mistake with regard to a one-sided peg. Basically what they're telling hedge funds is that go as short the Swiss franc versus the euro as you possibly can, because we guarantee that the Swiss franc will never go above 120. And so with that, they're inviting speculation. They're inviting all kinds of things that I think are not very good. And ultimately the peg can hold up as long as there's a political support, a public support for it. If you told anybody in Switzerland that the Swiss are going to adopt the euro, they would say no way, but the Swiss National Bank can do it de facto. Now, that means if somebody started an initiative, and you can start an initiative in Switzerland on any topic, that would block the Swiss National Bank from doing it, I think that discussion could, at least the risk that discussion could turn out negatively for the Swiss National Bank. And then you have a major problem there. So to me, the risks in the Swiss franc are too high. I don't consider the Swiss franc a safe haven anymore. With regard to the renminbi, we think that the Chinese have been pursuing many prudent steps in the right direction. Ultimately, for a currency to be worthy of a reserve status, you need to have it fully convertible. You need to have a vibrant domestic fixed income market. And China isn't there yet, but they're taking steps in the right direction to both develop a domestic and an offshore fixed income market. We are now in our Asian fund able to take offshore time deposits, so you don't have to use derivatives necessarily anymore to gain exposure to the renminbi, and other products that get renminbi exposure do very similar things as we do. What we think will drive China to allow its currency to appreciate is domestic inflationary pressures. Historically, China tries to control those pressures with administrative tools. Those don't work too well, and that's a good thing. The reason it's a good thing is that if the administration were effective, well, you would have a Soviet Union-style economy with product shortages. But because the Chinese do whatever they want anyway, no matter what the government says, you have this multi-tiered economy that functions. The problem is it's very difficult to contain inflation. Now, if you think about it, why would you allow your currency to appreciate because it might erode your competitive pressures? Our view is that countries that export more advanced goods and services have more leeway in allowing their currency to appreciate because they have more pricing power. Out of Europe, for example, you see very few low-end consumer goods being exported. The problem of the Japanese is not that of a strong currency. It is that they haven't invented the iPad, that they don't have this environment that fosters innovation. Similarly, currency debasement in the U.S. will help the next quarterly earnings report, but ultimately makes the country less competitive, also takes a major incentive away to reinvent yourself. So back to the Chinese. Within Asia, China is really at at the higher end as far as the goods and services that they're exporting, they're allowing their low-end industries to fail. And so they're taking all the right steps. They're doing it as far as how they allow the economy to grow. They're doing it as far as fostering trade with other countries. Australia and China are the latest example that they want to settle their trade in domestic currency. So they're taking these steps very, very seriously. We very actively talk to policymakers as well. We've had the SAFE, is the State Agency of Foreign Exchange, come and talk to us about what we want to see for us to invest domestically in China more. And while they're not there where we want them to be, they're listening. And so China has time and is taking those steps. And so we are very much encouraged by that. We think over time the renminbi will appreciate versus the dollar in particular. Clearly there's some risk to the Chinese economy as well, but what we are very encouraged with is that they're taking the right steps, and we are monitoring them very closely, and we are already accessing the markets where we can.
All right. Thanks for taking that question, Axel. At this time, we've got another Brain Trust member who has a question. That's David Nelson. David, are you with us?
Yes, I am, Andrew. Thanks for calling me in here.
Sure thing.
Axel, David Nelson in New York. I wanted to take the conversation back to Europe just for a second and follow up on some of your comments. And what I'm suggesting here is this is not original thought from just me. I mean, others like PIMCO's Mohammed El-Erian have said it as well. But it seems to me that, for the first time, we have a euro is worth something different in one part of the world than it is in another. And then you have the follow-up from that with the template comments from the Dutch finance minister suggesting that Cyprus could be a template for other bailouts in the Eurozone. If I'm a corporate cash manager here in the U.S. or another part of the world with substantial assets, say in the Eurozone in one of the weaker nations like Italy, Slovenia, Spain, don't I have to rethink my strategy in terms of where I'm keeping my assets and perhaps diversify them in other countries? And doesn't that eventually put pressure on the euro?
I noticed foremost that you didn't pronounce the name of the new head of the Eurogroup, the Dutch finance minister.
I was going to give it a try. I think it's Dijsselbloem, but it's such a difficult name. I decided to hand it off to you.
I have been practicing. Dijsselbloem is his name. Yes. So a couple of things. Clearly, if you are in the corporate world, what you want to do is you want to hedge your risks as closely to where they occur. And so that's why we see, for many years already, it's not a new phenomenon, do local production. European car manufacturers produce cars in the U.S. these days, and things like that. What happened until last July in Europe was that exactly what you were talking about. Banks in particular were siloing off their risks. There had been this European project where banks were active across the Eurozone. And then they realized, oh my God, the euro could break up. And so what was happening is we had banks and other institutions trying to make sure that our Italian risks are in Italy. So move the bank accounts to Italy for the Italian business, and have the contracts according to Italian law more than to European law. And it's that sort of fragmentation that Draghi pretty much reversed with his announcements in early August. Since then, the flows have been reversing, and you see that very well in what's called the Target 2 balances, which are the asset flows across the Eurozone. Now, having said that, clearly Cyprus was a wake-up call that there are still things to be done. Now, Dijsselbloem is a new guy. He is Dutch, so you can expect him to be more German than Spanish or Italian in what he's going to say. What Dijsselbloem had done, by the way, and that received just about no coverage in the U.S., in Europe it got some coverage, he let a bank fail in the Netherlands, and he wiped out some creditors in the Netherlands. That was unprecedented. I don't know why that didn't receive any coverage in the U.S. And so what he has said publicly is that he thinks risks should belong where they occur. The risk should be in the banking system. In the U.S., again, we also have our capital at risk when you're in the banks. Now, when you talk about Cyprus being a model, that's at the very least a very poor choice of words and shows that he's mostly very unexperienced. And he has since obviously backpedaled from that and clarified that no, Cyprus in this particular format is not a model, even though he had said exactly the opposite before. One of the reasons why Cyprus was so chaotic was that what you see, in order to understand Europe, you have to understand that policymakers from the Troika, the IMF, the ECB, and the European Commission come in and make a proposal, make a bailout offer, but they only set certain yardsticks. They don't do the micromanagement. They leave that up to the local bureaucrats. And the local bureaucrats are just completely overwhelmed. You already see how much backlash there is for what is perceived to be micromanagement from the rest of Europe. But if it were to take any further, you cannot have Merkel dictate exactly what has to happen in Cyprus. And so that's why you see this over and over again, that the local bureaucrats come up with fabulously stupid and incompetent decisions that they then have to backpedal on, because they're trying to save what they can save within the local framework. They don't know much about contagion. They just want to save whatever they can save, and obviously in the process they cause far more harm than they would otherwise. But there's a reason why these countries are in trouble. It's because they don't know how to manage their affairs, and so when they get these bailout offers, they don't know how to manage those either. Now, going forward, though, what has changed with Dijsselbloem as well is that I believe Europe is now strong enough to stomach this. Clearly, some bank depositors will vote with their feet, and that's healthy. You need to have these peripheral banking systems shrink. And if the policymakers don't do it, you need to have the depositors do it. Now, having said that, there are still some key differences. Italy is not in the news for the first time. The biggest surprise about the Italian election was that anybody was surprised that Italy cannot elect a German government or didn't elect Merkel. There is really no news in Italy. The Italian banking system is reasonably healthy, but at the same time, anybody in Italy has had an opportunity for a long time to open up a bank account elsewhere. Different from Cyprus, where you have your undeclared money from Russia that you're trying to hide in Cyprus, and nobody else wants to take your money. Maybe the Swiss might, and so it's very difficult to open up another bank account elsewhere. And so, yes, indeed, corporate managers have also taken a more prudent approach. Now, keep in mind, throughout the Eurozone crisis, the net flows were not out of the Eurozone. The Eurozone kept the current account surplus throughout the crisis. What happened is you had a flight out of the weak countries into the strong countries. A lot of that has reversed. One of the reasons you have the euro up so strongly is because people have now digested this, that Cyprus is something that we can survive, that the Eurozone can survive. Now, and let me just make one broader comment on PIMCO's El-Arian. He believes very strongly that what I indicated earlier, that central banks can buy time. His model, and I'm expanding here a little bit, does expand out to the U.S. as well. He believes that we'll buy enough time in the U.S. And policymakers will get their act together on entitlement reform. And I simply do not understand how he comes to that conclusion. And so this is, while I agree with a lot of what PIMCO says, it is to me not credible that the U.S. can come to entitlement reform without the encouragement of the bond market. And so my longer-term scenarios are very different from that, what PIMCO has. But as far as short-term analysis is concerned, yes, it's very thought-provoking, and it's certainly well worth listening to El-Arian and Bill Gross.
Excellent. Thank you very much.
All right. Thanks, David, for your contribution there. We are getting up to, I think, just one last question, so let's take a subscriber question. Will asks to Axel, what do you think the probability is for a major depression in the foreseeable future?
Well, policymakers have fought desperately to try to avoid that by printing lots of money, by stemming against the flow. And so you have a depression in Greece, you have a depression in Cyprus, Spain, you can argue whether you do have a depression or not. And so you have it in parts of Europe where they are attempting austerity. The challenge there is that they are not engaging in structural reform fast enough, and so those depressions are being dragged out. If you look at unit labor cost and the like, there's huge progress in Spain and some other countries, but you still have somebody like Rajoy, the Spanish Prime Minister, who rather raid the pension system than actually get his act together and engage in true structural reform that's necessary, so they're dragging things out. Depression in other places in the short to medium term are less likely because we are involving the printing press so much. And so in this risk-on, risk-off scenario, risk-off usually meant we don't print enough money. Today that mood comes up again because because our unemployment report in the U.S. wasn't good. And by the way, our gold is up $20 as I speak here, $21 right now. And that is because people realize easy money is going to be here to stay. And so we're going to continue to have this subpar recovery probably. We print a great deal of money. The biggest threat, maybe on a closing note, that we are facing, in my view, is economic growth. And the reason why I say that is because when you have economic growth, you have a sell-off in the bond market, and many of these scenarios I'm describing have a bigger chance of evolving. Right now, central banks get away with anything because this money doesn't stick. But let that money stick, it's going to be impossible to mop up properly. And so that's why it's not too late to prepare for those sort of scenarios. But that's why also the depression scenario in the U.S. anyway is less likely in the short or medium term.
All right. Thanks for your input on that, Axel. And we are getting up on the top of the hour, so we'd like to wrap things up. I'd like to thank all of our Brain Trust members for joining us today and sharing their ideas. As always, if you have any input or anything you feel is worthy of a discussion, please feel free to send your thoughts around via email. I'd like to also thank our subscribers for being with us today. For those of you who asked questions that we haven't gotten around to answering, I'll be taking a close look at those over the weekend and getting the answers to you in our next weekly update on Wednesday. We'll be having our next monthly call on Friday, June 3rd, and I'll have more details out to that as to the next special guest and investment topic as that happens. Thanks, everyone, for a great call.